Well, hello guys, and glad to have you on board again today. I think we're on the verge for a very much required update on a Cosmos staking, or at least if you intend to get investment or any invested money in the Cosmos in general, and that will add up to the previous videos that we've made on this very complex ecosystem it is. Though the thing is, today update is required because things have changed. We've mentioned that in the past. This is a constantly evolving ecosystem, and it does move pretty fast. And well, the recent improvements, things that we've anticipated back then, are actually happening right now. So remember, aka the interchain security transition, as the earlier lifespan of Cosmos Hub was kind of an undefined source of income by, well, basically undefined rules around airdrops. This was like weird stuff that we've explained in the previous video, and we've also mentioned that this was likely going to be turned down or very diminishing over time. Truth is, well, we were right on that one. This has been severely diminished, and some of the new chains are actually even launching without even considering a bit of an airdrop. So we clearly have confirmation that the hub was very well due to transition if it wants to survive. And those transitions back then were speculative. Now we're really much on the verge to see it. The vote for interchain security has passed, and the first consumer chains are going to be onboarded pretty much sooner rather than later. So yeah, it's an appropriate time to go by this ecosystem again and update, so that if you ever intend to put some money in the Cosmos, we're gonna have to talk a lot of things, okay? You're gonna have to understand that. Or if you're already invested in the Cosmos, well, we're going to discuss that. The angle today is going to be more about the security aspects of Cosmos, though securing the Cosmos. I've said it multiple times, crypto in general is just a Wild West kind of adventure. And the thing is that if you go by the crazy fucking high yield, you certainly don't generally understand the underlying risks with it. So the safest play in a cryptocurrency has, to me, always been securing the consensus. If you pick and choose the right actors in Cosmos, or in crypto in general, as long as you can pick and choose the durable actors on these ecosystems, the durable infrastructure layers, and there are not that many of them, well, if you just secure those chains, you're going to have some nice rewards without necessarily going to go, farming every fucking airdrop or whatever, okay? So there can still be some tremendous rewards by just pick and choosing the right ones and participating, securing their consensus, all right? And these are the safest best ever. No one can ever take your money out if you do this securing consensus. That's the safest bet to make while still taking some yields. All right. So we're going to take advantage of this by explaining everything that goes on in Cosmos. So early stages, remember, you could be able to stake Atom, you were getting to participate the consensus, and on top of it, you had juicy airdrops to compensate for the very weak price action of the underlying Atom token, because yes, so many people were right, it was a useless token because it has no intrinsic value, because, well, basically the Cosmos Hub sells nothing. Its block space were literally empty. Well, we're going to see that it has changed a lot. But first things first, I would like to reiterate the #1 mistakes that people do in Cosmos, all right? So the first, these are the #1 mistakes explained in greater details in the previous video, but I think I just can't go by with that video without just saying it over again. Please don't go by just saying, yeah, Cosmos seems great. People tend to be liking this thing, so what is Cosmos? Yeah, that's the Cosmos Hub. I just get to buy Atom and I'm going to be free of making some juicy gains. Well, like we stated, it's going to be complicated. We're going to say it and explain how this ecosystem works over again. This is infinite horizontal scaling, though it isn't going to be as easy as, yeah, just buy Ethereum and you're going to be a billionaire, all right? That's the same thing if you replicate that stupid narrative on, I'll just buy Atom and I'm going to be rich. Yeah, we're going to see that's quite not just as simple as that, all right? But second thing is, boy, if you even go by this mistake, like, yeah, okay, I'm just going to buy Atom because that's the only one that I have on my centralized exchange. Yeah, first mistake. But second one is, yeah, I'm not going to go out of my centralized exchange. It offers me, like, look at that. I don't even know how this thing works. All I know is that, yeah, Atom is this Cosmos thing. People tend to like it. And I'm gonna be willing to be part of it. Or worse than that, the chart looks cool. I'm gonna buy the token. Okay. Then, for whatever reason, you get into your centralized exchange and you go buy the thing that, oh, I can get some juicy rewards by, yeah, what is this thing? Oh, okay, it's an earned product, which is protected, no risk. I'm gonna stake. Yeah, I think I heard that thing. It seems pretty safe. So, okay, let's stake Atom for 30 days and I'm gonna get a nice 12% reward. Okay, now if you do the same thing, if you go by Coinbase, they're going to say, yeah, give us the custody of your tokens. We have them already anyway. Just give us the right to do some earn programs for you. Of course, in here, same old story, full of shit about how staking is great and stuff like that, and give you 6.12%. You would say, whoa, why do they give me 6% for staking when Binance is giving me 12 as an equivalent? Though first of all, they're really fucking up with you because, well, Binance is giving you double that. Yeah, so how can it be different? I mean, I just don't get it. There could be a slight difference of some fee purpose of whatever, but there's really something sketchy in here. And I would like to say, well, I didn't even imagine such a thing. When I came across these numbers, I was like, oh boy. Because let me just show you something else. If you just go by self-custodying your atoms, this is what you make, okay? 21 a year. All right? And I'm not even talking about auto compounding, which is increasing even that number. So these exchanges, of course, you're probably going to have to get through them to get to buy your first tokens and entering the Cosmos. But once you've done, number one thing to do next is to get the hell out of here. Though there are multiple ways to get out of it. You can do, number one to me is going self-custody. And the number one solution to self-custody is to go buy a hardware wallet, which is going to put kind of in a physical object in between you and your transactions. Though that means the transaction process is less of a seamless stuff, but that also means anybody can just try hacking your computer or whatever. They're never going to be able to take any tokens out of you. So I think to me, self-custody can hardly be done anywhere but with a hardware wallet. So go buy one. Otherwise, well, if you just want to go easy with the seed phrases and stuff like that, make sure the seed phrases are safe. I hope you know that shit already. Well, then you're going to have to download the Kepler wallet and create some wallet addresses, okay? And then, of course, you're going to get your wallet address, copy it, extract your tokens from the centralized exchange, and get the hell out of here, okay? And then, if you want to do anything in these things, you're going to be able to stake your tokens very simply, okay? Like download, create your wallet address and stuff like that. And then if you do that, well, just hit the fucking stake button and get the hell out of these exchanges, all right? In here, number one stuff, you're going to be able to choose some validators, which is what you can't do. I mean, in a centralized exchange, Coinbase is going to delegate your tokens to Coinbase custody, all right? And just look at what we've stated back then. I mean, they're getting 17% for anybody, okay? Like, if for whatever reason you were so much liking Coinbase that you still want to give them your money, well, they will give you 17% if you self-custody stake, which means you just get the tokens out of Coinbase into Kepler or whichever other Cosmos wallet and delegate to the very same provider, you would get 17%. While inside the fucking platform, they're giving you 6%. I hope you see how staggeringly different this is. And this is the number fucking one validator, which means there's so many people making that mistake. Though I hope if you know anyone who's getting invested with Atom, I don't know, a friend of yours say, yeah, look at that token, it looks great, whatever. Just share that fucking video to that person. It has to know this. Get the hell out of centralized exchange. Not just because they're just scamming you with the rewards you're getting, but just in a simple few clicks, you will get out of it and just get more than double the rewards. It's not just ending there. It's even worse than that, and I'm going to go by explaining that later. Remember what we stated earlier. Cosmos is complicated to get. It's a really complex ecosystem. It's a totally new design out of what's been done previously, which is trying to extract as much vertical value as possible. Well, Cosmos, by design, has always been fighting against that by saying, yeah, we're going to have an open consensus. No one, everybody's going to be able to join, even though participation in the economic consensus is going to be limited to a few validators, because we're going to use a Byzantine fault tolerant kind of consensus, which means we just can't get that many transactions per second if we want to get validators. So remember this trilemma, blockchain trilemma, you just can't get infinite speed with infinite decentralization and infinite security. So in terms of Cosmos, well, the security isn't a trade-off, just can't be possible. So security is unbreachable, like major proof-of-stake consensus are. Though remember, I'm not going to go down all the details, but whoever tried to cheat in a proof-of-stake is stupid as fuck, as long as the consensus has been well designed. But the thing is, that's really the way it is, all right? It's infinitely complicated to gather and coordinate an attack on proof-of-stake consensus. And more or less, you're inevitably going to be caught up, and when you get caught up, all the things that you've put in collateral, and they generally represent billions of dollars, well, you're going to have to lose it. So it's really the way it is. If you try an attack on a proof of stake, you're inevitably going to be seen as a malicious actor sooner or later, all right? Because people can reprocess transactions, and we'll see that in Cosmos it's even simpler than that. Though you will inevitably be caught up, and you will inevitably lose what you put at stake. So it's inevitable loss at the end of the game, and anyhow and anyway, there's so much to gain by truthworthily participating in those consensus. It's really an economic system that's rewarding those who do work correctly. And we're going to mention that again when it comes to Cosmos, all right? The second particular stuff about Cosmos is to understand how its consensus actually works, all right? So it goes by the set of validators. Number one stuff, okay, if you truly want to be called a trustless, decentralized, though permissionless blockchain and stuff like that, has to be fucking open source code, which means anyone can come and download the code, run the software on any computer at once, and be able to see, receive, and process transactions, all right? And to verify the integrity of the data that's written on the public blockchain, all right? Though I've seen many confusion out there, like, I don't know, stuff with private code or permission code or whatever, like, I don't know, the quant networks and ICPs and stuff like that. Okay, this is not public blockchain. This is nothing but that, okay? Though in here we're in true public blockchain technology. You can download the code and run it. The thing is still, like we've mentioned, this is a Byzantine fault tolerant, which means this trade-off that has to be made on the blockchain trilemma is, well, not everyone is going to be able to write in the blocks, okay? Anybody can verify that the blocks that have been written are right by writing them themselves as well, all right? And you would see the first thing that people generally don't get with Cosmos is that, well, we have 175 validators in Cosmos. Yes, that's right. That's what you heard. Cosmos Hub is basically 175 validators. That's the 175 validators who are actually writing blocks on the public blockchain, and they're the 175 ones that are able to bring as much collateral as they can. Okay, we take this 175 best of them, and they are the only ones available to the lottery of writing the public blocks. Still, you would say, why the heck is 500 validators though? Because like we stated, this is open source code. There are 500 people that are actually receiving transactions just like the 175 others, and they do process their own block. The thing is that they just can't write to the public blockchain because they don't put as the necessary required minimum collateral to get into the game, the proof of staking, all right? But once again, anybody can go there. So if you try to cheat in a Cosmos Hub, for example, let's say you know about the 31% attack or 33% attack. If you own 1/3 of the share, you can start doing something with the chain, which is just stopping it. You certainly just can't write falsified information with 33% on Tendermint or Comet BFT. I mean, it's been renamed. Topic for another day. The thing is really, well, it's very, very secure, okay? Tendermint, Comet BFT, very, very secure. Just you need 66% of the stake to actually start writing bullshit in the blockchain, all right? And the thing is, if you ever do it, remember that you're going to have 66% of the share, which is, I mean, absolute tremendous amount of money and coordination required to do this, and everybody will be seeing you in the process anyway of trying to get control over the chain. But even if you manage to do this, well, there's still going to be more than 300 external validators who will see the shit you've made, and they will be there on social media to say, well, this block has been falsely created. We have the proof that the transactions haven't been processed correctly. Just kick those guys out and slash the collateral, all right? So understand, these things can't be faked. There is no way, all right? But what you need to take out of it is that there is still an economical constant battle, all right? If you understand that if you want to secure the Cosmos, which way or whichever blockchain, it's always the same. They all have the same core for security, all right? At least for now. Though this is how it works. This is a game of stake in which we take a limited number of validators we can bring the more stakes. So there is constant competition between those validators, but this is an open set, all right? Then what you need to understand is that, well, the interchain is composed of self-sovereign blockchain, which means Osmosis has its own validator set, Cosmos has its own as well, and the things that we mentioned back then is that there is kind of a severe overlap between all the chains, which means the validators themselves, the entities behind those consensus operators, tend to be kind of similar. There is a tremendous similarity on validators in Osmosis and those in the Cosmos Hub and the like. There is, of course, some significant difference as well, but there is really sense of overlap, which means even though each validator puts a different collateral on each chain, remember that in Osmosis chain, the validators stake Osmo, or they get delegated Osmos, though Osmo is the security collateral. Same thing for the Cosmos Hub with Atom, with the Provenance chain with its own token. Okay, so each chain has to have its own token, and each token in here has its own relative security collateral level, all right? Which is one thing that makes the Cosmos very granular at every scale, which means every chain in here is sovereign, but it has some different layers of security. The Cosmos Hub is by far the most secure chain in the Cosmos. Some of the chains have very limited market cap, which could make them vulnerable to attacks. Even though, like we stated, writing some shit in a BFT like whatever is in the Cosmos chains, basically that means you're always inevitably going to be caught up, all right? The thing is, you can still, if you take control of these chains, write some falsified informations in the blocks temporarily, okay? So anybody who tried to cheat in Cosmos is inevitably going to be caught up, but the thing is, it can still, with a tremendous amount of collateral and coordination, write some falsified blocks temporarily. Though that's how security still is a crucial thing, because in an interchain like that, where information can be processed on different chains and coordinated, because information can be written and read from other blockchains and the like, with the interchain accounts and the things that are now live on the Cosmos, which means if one blockchain gets to be corrupted, it could have tremendous consequences on other blockchains being connected to it. That's the reason why this different layer of security is going to pose a critical threat in the long-term development of Cosmos. We'd rather like to have a standardized level of security that at least guarantees the base layer. Because remember that the interchain is based on self-sovereign blockchains, each and every one being open source, which means anybody can take the code and fork it. And remember what we stated, it can only do one thing. In these kinds of ecosystem, there's only one possible future, it's specialization. As long as the code is open source and anybody can fork it, that means each blockchain, if it wants to survive in this competitive open environment, has to be the best at what it does. All right? It's a constant improvement. If you, for whatever reason, you just say, all right, I'm the best one, I can just stand still now, well, someone else can just come over, take over your shares. All right? So you constantly have to evolve and maintain the market shares you have. All right? So these blockchains, like we stated, they do generally one thing, one specific thing. That's the app chain thesis that is now just being exported everywhere. Even Ethereum is wanting to have its own app chains now. So it's really the winning thesis. I've said it back then that it was inevitable, and now it seems like the market is proving me right. But the thing that you have to understand is that intercommunication with these app-specific blockchain is the next crucial step. If these things don't intercommunicate, well, there are isolated, very technical kind of stuff, all right? But what makes it very good for the end user is to have those app-specific chains interacting between each other to create a complex endgame service, all right? So yeah, it's always been the case. Cosmos can only succeed if we have those app-specific chains constantly improving themselves on their specific use cases, and then we can get a kind of an intermediate mesh by bringing all those chains together and making them communicate, so that one people can use these services and then bridge it to that and that and that and have a complex routing system in between the Cosmos. All right? Sorry about that. The thing is that the critical level of security is forever going to be very interesting and important in this ecosystem, because if we got to have that multi-hop kind of system in which information travels across the interchain, well, the referent level of security, if tokens or any value gets transferred or just any type of information, it's always going to take the critical level of security, which means if we go on a multi-hop, let's say you've got one service that's going to go on hopping 6 different chains for each and every referring different use cases they have, all right? Like, the thing is that those 4 chains you're going to go by, all right, there's going to be a relaying layer in between. And as we stated earlier, what you really need to understand is that each and every time you interconnect 2 blockchains, there are 2 validator sets sending and receiving the message, all right? But the thing is that if you have on one end one chain with a critically low level of security versus 3 other chains with very high level of security, well, the overall net security level of the overall set of transaction is always to the lowest, which means if you were drawing a line with the relative level of security, okay, this is the relative level of security of this chain on a y-axis, okay, this one's very secure, this one is even more secure, and this one is kind of average secure. Well, the thing is that the overall security of this bulk transaction is going to be the lowest critical point, all right? So that's one thing we need to understand. There's going to be a security challenge in the Cosmos ahead as the interchain's vision is getting closer and closer to reality. It's actually even reality now. It's working just in front of you guys. But the thing is that you understand that critical level of security. It's always the weakest link in the chain that sets the security standard of the overall chain of transaction. And that could put the Cosmos vision at risk if for whatever reason we've got those massive shifts in security. That's where interchain security is intended to go by. Interchain security is going to go by multiple stages of maturity, and first of all, we're going to have to go by them because you need to understand them in order to fully understand how the heck this goes on securing the Cosmos and the evolution of it, all right? So basically the way we were now is this. Each and everybody deploying in Cosmos can do it. Just take the Cosmos stack and so on. But they're going to have to raise their own validator set. They could likely just contact the existing validators because most of them are validating most of the chains, okay? Though you can reach out to existing validators and offer services. You're going to have to give them some tokens and stuff like that to finance their operations, and they're going to start securing your chains. That's how you decentralize a validator set. By AKA today, it's basically reaching out to existing validators on other chains and offering services to them. All right? Next stage of Cosmos security is going to change dramatically because of this new model that is actually happening now, and it's going to start maturing throughout the next couple of years. All right? So that's the interchain security model. The first interchain security model, which isn't visible in here, is called replicated security. That's the one that's been voted a few weeks ago, and the first chains are going to be onboarded ASAP. But the thing is, basically in here, that's kind of the V1 of a much more complex system that's going to evolve until eventually we get to the final stage, which is mesh security, aka cross-chain staking and slashing. So we'll explain everything about it. You have to understand how this thing works, okay? First of all, the delegators are the core basis of the system. That's the token holder, all right? Remember, that's the ones that can choose if they want to secure the consensus, which means that's the #1 problem for many of those chains. Many of those chains have also a service to do, okay? Like Osmosis is a liquidity provider or liquidity aggregator of some sort. This is more complicated than that. I mean, Evmos is trying to provide EVM execution and stuff like that, which means the Evmos token and Osmos token and any other token in here has to do 2 things at once. It has to both serve as a fee token for the services that the blockchain is actually performing for the user. It has to be a governance token on top of it because it serves as decentralizing the governance for the blockchain or can at least. So it's a fee, a governance token, and on top of it has to be a token for security, which means some of your token holder base has to choose to delegate to security providers, the validators. And remember what we stated earlier, that's how the consensus actually works. Because we only take the 175, or at least that's for the Cosmos Hub, who can get as much delegation as they can, okay? There could be an infinite numbers of validators, but only those who bring the higher stake, at the higher capital stake can be able to write on the public blockchains, okay? So that's the way it is, all right? It's a capital game. And the thing is that it takes away and it erodes from the actual token of each blockchain by forcing some of the token supply to serve for security. All right? Though the promise in here of interchain security is to say, yeah, maybe some use cases might not necessarily require the token, the deployed token, to serve for security. It can still very well then serve much better the next other two. Have a much better governance token and a much better fee token because you remove the security in the equation. So, like we stated, this is getting further down the line of specialization. Though there would be security provided chains and other chains will just be there to provide a service for a fee and of course have their own token for self-sovereign governance. This is really the way it is. That's the way Cosmos is naturally going to evolve. Security is going to be served as a service. You don't have to run their own security on your own chain. You better have to concentrate on how to run it, the governance, and how to make the best possible product. And therefore fill your blocks with service providing with the best possible quality. Makes quite a lot of sense, right? So the thing is, interchain security emerged. The first stage has been replicated security. So if you got it right since then, you have to understand that there are 175 validators in the Cosmos Hub. It diverges on some other chains, but basically, well, replicated security is the consumer chain, which is going to rent the security from the hub, is going to have to take it all, okay? It's taking the entire Cosmos Hub validator set. The 175 will be eligible to validate the consumer chain, all right? AKA, basically, this is a validator choice. The validators still have the choice not to do it, okay, to say, yeah, no, it's too much of a technical overhead. I'm not going to do it. I'm just going to keep validating the hub. Though it's going to create two things, all right? If you are a validator who doesn't validate the consumer chain, well, that means the revenue flow between the consumer chain and the main chain, the provider chain, it means the consumer chain is going to have to pay for security. Generally, that means that 25% of the fees generated by the consumer chain is going to be flowed back into the Cosmos Hub. Delegators, okay, remember the token holders will get, those who stake to validators will receive these additional revenues, okay? Of course, token holders who don't stake will get nothing for interchain security. Remember, security comes only if you stake your tokens, all right? The second thing is that, remember what we stated, you're going to have to stake from your own self-custody wallet, which means, well, interchain security, we absolutely know nothing about what the actual centralized exchanges are going to be doing with it. Are the centralized exchanges going to reward you with the tokens you're supposed to be delivered? Or are they just going to keep it for themselves? You absolutely don't know. All right, but you have to understand this. In interchain security v1, replicated security, all the validators can opt in or not to validate the consumer chain. If they opt in, they're going to get an additional reward, not just the atom inflation, all right? And, well, good luck for centralized exchange delegators because you actually don't own the tokens, all right? Remember, not your keys, not your coin. Moreover, they're fucking you on the rewards already, so God knows they're probably going to fuck you with the additional rewards as well, and they're going to probably keep them for themselves, all right? So, I said, once again, don't go for the fucking centralized exchange. They're scamming you already, so they're probably going to keep on doing more. All right? But anyway, that's V1. V2 is going to introduce a bilateral governance in this agreement, this security agreement, which is, well, Neutron, okay, is going to be able to choose whichever part of the validator set they're going to be willing to be validated by, okay? Which means it's not just Neutron has to take it all and the validators can opt in or not. Now it's a bilateral agreement, which means Neutron is going to contact the validators, Remember, that's exactly the way these things actually work today, but these new chains have to bring up their own tokens and give these tokens to the Cosmos validators, okay? Now it's not going to be this. The security is going to be collateralized by the atom, and you do not have necessarily to raise a token. One more thing is that consumer chain don't necessarily have to have a token. There could be some consumer chains without tokens. And that's a critical part of the infrastructure. Those chains who just want to serve a service and don't want to have a governance will not have to run a token. They can use Cosmos governance and they can use Atom as its fee token. All right? So that's one thing to improve the model. We could have chains without tokens. Because the only thing that requires a token is the security. Remember, this is proof of stake chain, which means you just can't write block if there's not something at stake. What Cosmos Hub does now with the replicated security or interchain security is allow for the first time to have chains making services without a fee token, without a governance token, without a token at all. All right? Still, you have a publicly visible blockchain with uncorruptible blocks. Okay? So that's something. People don't really talk too much about it, but it's important. So step 2 introduces this, the relationship, which means, well, the consumer chain is going to be able to choose if they want just a portion of the validator set or not. So they can define the layer of security. It adds some granularity. Like say, for example, I just want the maximum security. I'm going to take it all. Or I just want to have, for example, just a limited set of validators that I trust a lot. I have some political alignment with them, and I just want to use them and not the rest of them. Okay, then you have a granular level, okay? Though you can select how much security you want, and that's going to allow the consumer chain to define a cost basis for the security, which means if you take less of the validator set, you can eventually pay less of a fee back to the atom holders of these validators. So this creates crazy shit granularity, which means you are now introducing economic politics in here, which means, well, the consumer chains will be able to choose certain types of validators. So now, you as a staker, if you don't understand that, you pass on for a serious trouble, because once again, there is a Cosmos ethos. The chains that are the most likely going to use the Cosmos Hub in here are the chains that have some kind of deep alignment with the hub. And there's one thing that we've always made it clear, even in previous videos. The thing is that, boy, there is the Cosmos ethos, which is definitely against centralized exchange. So there's one thing I can tell you for sure, is that when we get to interchain security v2, when the consumer chains will have an opt-in on the validator set, what do you think is the first thing they're going to be doing? Getting the fuck out of centralized exchange, meaning they're going to exclude the centralized exchange from being able to receive their tokens. That's probably the first thing that's going to happen. So remember with that, delegate to a centralized exchange. First of all, they're already fucking you with the APRs. You could get more than 21% if you even compound your tokens, which is easy to do. There are multiple trustless tools doing it for you. Well, on top of it, like we stated, there are multiple problems. They're probably not even going to get you the additional tokens they will get from interchain security v1. Most of it is going to be absolutely deleted from interchain v2 because most of the actual consumer chains will probably exclude the centralized exchange from receiving the tokens and participating in securing their own consensus. And that's really adding up to the thing that get the hell out of them, all right? But it's not the end of it, all right? So that's the crucial thing. When we'll get to interchain v2, things will start to change, and specifically targeting the actual centralized exchange first. But the second key-school effect is that, well, lots of the validator sets is going to be split in between multiple groups of validators, creating some kinds of alliances and stuff like that. So pick and choosing your validator is going to be crucial in here, because some validators will likely be more demanded than others, okay? So today, the validator set is kind of equal. Every validator is providing the same services for the same chains and the like. This isn't going to be the case a year from now. We're going to get interchain v2 by then, and the thing is that basically that means validators will provide different types of services. You're going to have validators who are going to validate everything and bring you shit tokens in the process. You're going to get all the validators will have more concentrated effect, pick and choosing only the right ones, and like that. So there's going to be an absolute disparity in the validator set, though pick and choosing your validators tomorrow is going to be very important, all right? because it's not going to be just, yeah, whichever is doing it. That's the way it is today. You can delegate basically to whichever validator. There are a few things that we've mentioned back then, like the fee and the participation governance. These things are going to be more and more muted against the choices that your validator actually make in its security delivery. All right? And then comes interchain security v3. This one's very, very, very much important because remember, the hub is the chain that does it best. The hub does nothing. It makes no other service but to share its security. And remember the thing, we've always said, multiple chains have external services. Tenu is there to provide WASM contracts. Osmosis is there to provide aggregated liquidities and stuff like that. Quicksilver is going to be there to provide liquid staking. AKA, basically the thing is that they do have something to pay attention to. They do have stuff to fill the blocks, though their token has an utility. Additional to provide its own security, the thing is that the hub does nothing but just that. The hub doesn't serve anything but to be a vault, a secure vault for any IBC tokens to be deposited in, all right? Though hub, Cosmos Hub, is security top-notch thing, okay? Though shared security v3 is saying, well, we can mesh this thing and we can have the best of both worlds. Like the existing blockchain, which already deployed their own validator set and already used some of their token supply as a collateral for security by having the token holders staking the tokens to the validators, okay? They can get the best of both worlds. I can still have my inner security, which means if for whatever reason I don't want this now, I think I can sustain myself, my security myself, well, then I can opt in and out. Okay, I can still survive on my own, but if for whatever reason I lack of security at a given time, like aka bear markets for examples and stuff like that, I can at any moment rent the security from the safest place out there, the Cosmos Hub. That is absolutely tremendously much more complex in terms of use cases, and I can hardly even go down this path because there are so many use cases of interchain security v3, which is going to probably create tremendous demand of Cosmos Hub security. But not necessarily at all times, all right? That means Cosmos Hub will not just be there to secure its consumer chains, which are very much going to be servicely and politically aligned with the hub, but also going to be able to secure other chains that might have inherent level of security dropping down at some point. And remember what we stated back then, if you go on a multi-hub system with different level of security, okay, it's always the weakest link that wins. Though the thing is, having the hub securing the interchain and maintaining a critical level of standard-based security all across the most used interchain protocols and app chains, well, that's one thing the hub has to do, and this is interchain v3, all right? The Cosmos Hub will not only serve deploying its economic value to the most aligned chain, it's getting closer with it, but securing the fucking all interchain, all right? It's really, really important to understand that critical low level of security across multi-hubs transactions. It has to go to the critically low level of security, and I think the hub will be there to set that standard at least at a minimum threshold, okay? And then comes the latest update, which is the one that's been brought up by the ideas of Osmosis, but not only, the mesh security, aka cross-chain staking, aka cross-chain slashing, which would be, well, coming out of the idea that we've mentioned that there is significant overlap in between the validator sets of different blockchains, okay? But that's a different vision of go-to-market, which says, well, we can still do interchain security v1, v3, but in the same time, we could also do this to say, well, the validators who actually validate on multiple chains, like for example, my validator validates on the Cosmos Hub and on Osmosis, I can set an agreement for my delegators to say, well, I'm going to provide security on both of these chains, though the collateral you deposit on both chains to my validators, I'm going to join them, which means I'm going to bring a higher security to the Cosmos Hub, because if I misbehave in the Cosmos Hub, I'm going to get slashed my atoms and the Osmosis token, okay? But that's really crucially important for you to get that one, all right? Though in here, we're gonna have to explain one very crucial thing about that, all right? Because if you understand that thing, this is kind of bringing the same kind of interdependency, that's great, but in here it introduces the notion of slashing, which we're gonna have to talk about, because this is something that people generally don't get to understand a lot about. Though, let's jump into the next stage and talking about the risks of delegating in the Cosmos. Because, well, so much of the time you would say, yeah, I'm getting a juicy reward. There might be some hidden risks that I really don't understand. So, The first thing you're gonna have to understand is when you delegate to a validator, the first thing you do is that you also bonding your tokens. Though there will be a 21-day lockup that's inherent to actual staking systems. I mean, if you were able to take in and out your tokens immediately, well, there will have no collateral value. So the thing is that you have a 20-day lockup period, 21-day, though these things can change, and there are several features in the Cosmos and blockchains building to try reducing the collateral damage risk in here, and therefore it could possibly be reducing the lockup period. But well, for now, it's been protocol defined to 21 days, which means if you self-sovereign delegate to a validator through your own wallets and stuff like that, you're going to be bonded for a 21-day lockup, which means if you want out and retain liquidity from your tokens back in, you're going to have to wait 21 days. We'll see that there are other options like liquid staking that are available in Cosmos. I'll go back to that later. The thing is that though the undelegation is 21 days, all right? If you want out, you're going to have 21 days. There's redelegation, which means you can at any moment change your validators. If for whatever reason your validators doesn't do the best job to you, you can switch to another validator without problem. There's still going to be a 21-day redelegation timescale, okay? Which means if you redelegate it to a new validator, you just can't get out of this validator until 21 days. Makes sense as well. The capital has to be locked in, okay? Then comes voting, okay? It's very crucially important. Voting, the governance of the token in question, Atom in here or any other Cosmos chain, okay? As long as you participate in security, though you delegate your tokens to a validator, the validator gets to cast your vote on top of it, which means if you don't participate in a governance, the governance is inherited by the delegation to the validator. And that's something you really, really need to understand, okay? It has some crucial implication in the governance because basically, as long as you're participating in securing the consensus of one chain, if you don't vote, then the service provider which you delegated your tokens to is also inheriting governance powers. Yeah, that's one thing. We're going to talk about that as well at a later stage. But we've came here to understand that when you delegate your tokens, you're also allowing the validators to slash. Okay, that means it's not the validator. I'm quickly going to explain how it works to remove every bit of uncertainty out there. Okay, so this is written on the protocol. Okay, remember on the code of the blockchain. When you delegate to a validator, okay, this is one validator among a set of 175 of the best validators that have been chosen. Anybody else can see and participate, but they just can't participate in the public consensus, okay? So take the group of those 175 validators, all communicating with each other, all right? One has been picked to be the one to create the block. So it creates the block, it commits the block, everybody gets to look at the block and see if it's valid or not. If for whatever reason there is a problem in this block, and this validator who's get to created it is rejected, and everybody else says, no, you've just tried to do something wrong in here, we can clearly see that you've cheated, so you've done something wrong, all right? We're gonna go and slash you, okay? So this is an agreement by a majority of the other stakers, of the other validators to say this guy misbehaved, so we're gonna have to slash. Though slashing comes with different types of slashes, and you have to understand them because most of the time people just think if the validator does one mistake, I'm gonna lose it all, so I'd rather like to be scared of staking. Well, turns out it's not. So there are multiple ways in which you can be slashed. The first one is there is the double spend. So this is the worst of all. That means you inherently willing to cheat. You've done it in purpose. There's no way to double spend in a blockchain without willing to do it. All right. So it's really a coordinated attack. You're gonna have, if you want to double sign, either you to double spend, either you're stupid or you're coordinated with the other guys in the set to do it without being punished for it. So that's the worst case scenario. It can't happen. Like we stated, it requires tremendous amount of coordination and money at stake. And moreover, even if you if you succeeded in corrupting the 175s that are actually participating in a public blockchain writing, there are still 300 more that will all be able to process the same transactions and will all be able to see that you fucked up. All right. So you can't lie. You will inevitably be visible and publicly disclosed, okay? So that's one thing. The double spend, I mean, Jesus, can happen, but it requires a critically low level of security on the chain. And if it does, it's only going to be a temporary cheat because people will always be able to process the transaction again and see that you've shitted around. All right? So you can only temporarily write some shit in the blockchain. You're inevitably going to be caught up and you will inevitably lose it all. Because if you do it, well, the slashed collateral can go right up to 100% of the deposits. All right? So that's the worst case scenario. But the thing is that everybody thinks that's just it. Well, like we stated, it's never going to happen. Never. Though, what are the other types of slashings? The more probable one. Though the second one is what we call a double signing, which means the validator is running two parallel instances of validation, and it requires to be an absolutely shitty technical operator to do this. So once again, if you have a validator that double sign, well, Jesus, you probably should think about redelegating. But if it ever happens, like you really have delegated to the shittiest validator out there and they've managed to double sign, okay, double signing isn't double spending, that's different, but double signing is like running two parallel instances of the software, which can corrupt the signature process. So if you do this, well, that doesn't work out, that fucks up the consensus, the block is rejected, and well, in that sense, ooh, the delegators are going to lose 5%. Though 5% is something, but remember, you're going to be paid almost 15 to 20% a year. So that means even if your shittiest validator out there were to double sign once a year, you would still be by large a profitable staker. All right. So once again, that's a risk. This one is and can happen. It happened, but it really happened to shitty validators. True good technical operators will never ever do this. All right. That's really important for you to understand. The validator's downtime, that's the last way that can be slashed, and well, that's the one that has the likeliest chances to occur, but people don't know the details. So I'm going to go all over them so that you really know everything there is to know. A validator, okay, can get slashed 0.001%, 0.01%. I mean, remember what we stated, it's a 15% average return over a year, 20% in some cases like we are earning now. And that's not even auto compounding. So the thing is that, well, if your validator forever, for whatever reason, goes downtime, and it has to be more than 18 hours, you're going to be slashed 0.01% of the deposited capital. So you're not even going to see it happening. All right. So the downtime risk is more as well, not a collateral slash risk. It's more like if your validator is out for a few days, you're going to lose 0.01%, but the thing is that your validators being out of the consensus means you're not going to get the block rewards, okay? So every day in which your validator is out is going to bring you closer to a, massive 0.01% slash, but you mostly are going to be punished by the fact that every other validator is going to take the daily block rewards, not you. All right, but that's really the way it is. It's just a losing money game in here. It's a losing gain. That means you could have made money and your validator is too stupid to be downtime, so you're not making money. Okay, so you're not going to lose capital. Let's sum up everything. If your validator is ever willing to double spend, well, good luck with that. It's a malicious validator day one. None of the validators are entrenched to do this. That would be too stupid, because whoever would be caught doing this once will never, ever, 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 ever be able to validate any other chains in any other crypto. All right? So that would be stupid to do it. Second thing, well, the double signing could happen if your validator is really full of shit and doesn't know anything about the technicals he's running. And in that perspective, ooh, that's a staggering 5% slash. And once again, this is meant to send the message. If it ever happens to you, well, that means your validator isn't good. You just have to redelegate. And like we stated, you're going to take a 5% loss and you're going to immediately redelegate to another validator. All right? That's kind of a punishment to say whoever isn't sophisticated enough in terms of technicals is going to be pulled out of the validator set organically by just kind of punishing without killing its delegators. It's going to inherently force them to move away to another validator so that it doesn't happen again. So any validator who ever double sign is going to be guaranteed to get out of the validator set almost. All right? Every validator who's go with a downtime isn't going to cost anything to the delegator, but just losing some gains. On the second hand, like we stated, going downtime can happen for many reasons. We've seen some data centers going down or whatever. So if for whatever reason your validator is unlucky and get hit by a downtime, well, this is how its technical abilities are going to be put at stake. Good validators are going to be able to go out of downtime and go back up running the consensus as quickly as possible. Those who for whatever reason take more than 18 hours will first of all show their relative lack of competence, but they're going to have to communicate to explain the problem and so on. I mean, life can be complicated, but like remember that, okay, a good validator should have very limited to no downtime, should never double sign, and will never ever fucking double spend. All right? So the risks of slashing in staking consensus in Cosmos, I'm sorry to say it, folks, it's close to zero. All right? If it ever happens, that's this one that's going to happen, and Jesus fuck, I mean, that's not even worth mentioning. All right? Though no capital exposition unless you choose a truly, by definition, malicious validator, which we stated makes no sense in a proof of stake. All right. So we know everything about slashing now. We know everything about cross-chain staking, cross-chain slashing. We know everything about mesh securities vision. We know everything about interchain security, how it works, how it's going to evolve, the mechanics of it through the validator set and so on. So now I think it's about time that we look at the fucking validator set itself, all right? So here's the validator itself. Validator set itself in Cosmos. So remember, we take the 175 best of them, and you will see, oh, which ones are the winners. We've got the Coinbase custody. Oh boy, we find our good centralized exchange, or Capital Depositors Exchange. Doku Capital is a fund. Zero Knowledge Validator is a fund. You will also see some chip validators. As SG1 was offering a 1% fee for a long time, so I'm going to quickly go over the fee module in here to explain it all. Binance as well, okay? Though in here you can see the number one validators are like capital validators. Game is a centralized validator, Polychain as well, so is the other ones, okay? So of course, in here you find all the top validators of the centralized exchange. So like we stated, it will change because interchain security V1 and mostly V2 will likely put these guys out of additional rewards. So that means over time, I expect these to go out, just as people will get more and more entrenched to understand the fuck is going on because they take so much money out of their backs. So I hope they're going to get out of these into any other validators. So the question is, how do you choose those validators? Remember in the previous video, we've made a very, very simple explanation of it, an answer, which is not true, or it was a partial answer, but at that time it was good enough. We stated there are two major constituents to choose a validator, the commission rates and the participation in consensus, all right? Remember that the validator inherits the vote if you don't do it, all right? And most people just don't vote, so there is a significant governance impact. So back then we stated, well, take on the validators that have more an average commission rate and that do participate in governance, because that's the number 1, 2 factors that you should pay attention to. And try not to delegate to the top validators to improve decentralization of the validator set. AKA, try to delegate to validators outside of the top 20 who participate a lot in governance and who has an average fee. Okay, try to get out of those who take 10 or 15%. All right, the average fee in the Cosmos hub is somewhere around 5%. So you would see some people do less, some people do more. It's an average 5%. Oh, then you would see 0% fee. What the fuck is that? I mean, I can delegate to this guy and get it all back to me. Well, folks, then how the hell would I choose any other? I mean, I'm going to make more money with this guy, so let's roll it. All right. Though I'll go down this path very, very quickly. 0% fee validators are just as much hated in the Cosmos ecosystem as the centralized exchange. So you can be very well damn sure you're never going to get a single airdrop from these guys. You're never going to get a single additional revenue from interchain security because the 0% validators are literally, like I said, hated. Moreover, most of them don't even give a fuck about the actual governance. So the no fee to 2025, yeah, sorry, I don't think they're going to be there a couple of years from now. We'll see all about that, but lots of pressures going to come out of them, okay? 0% validators are literally excluded from airdrops. Even if we stated those airdrops will likely diminish over time, there's still some of them coming along the way, and you're definitely not going to make any advantage of this additional revenue. Okay. Second, last but not least, if these guys don't go back in line to put some fees to align with the general consensus, they're going to likely be pulled out of interchain security V2 because the consumer chain will choose not to delegate to them, or will choose to exclude them for their validator set. Okay. So yeah, forget about the 0% stuff. It's definitely not going to make it on the long run. Okay. I think they're going to exclude anything that is below 3%, so Imperator as well. Okay, low fee validators are likely going to be pulled out of the actual consumer chain validator set for those very same reasons. Okay, the thing is that the Cosmos ecosystem has an ethos, and the ethos is, well, if you try to play the dampened stuff of trying to get more delegators because of cheap fees, well, you don't play the game. All right. So that's really the way it is. If you don't play the fair game, you're probably going to lose revenues. Okay, so forget about the 1%, forget about the 0%. Try to stick with the consensus. 2 to 6 to 7%. Anything higher than 7% is kind of a waste. And more of it, I'm just going to show you a quick calculation to put it into the reality scheme. Okay, so here we go. Taking a calculator, I'm going to take a 1,000 atom delegation, which is by far higher than what the average FO does hold. Just to show you how irrelevant the actual fee shift truly is. So if we go for a 15% annualized return, okay, which is kind of, I think, what the average is going to be, before the next stage of Cosmos shows up, where inflation is going to be reduced over time, but we're not yet there. So let's go for a 50% yearly return, okay? That's going to be 150 atoms to you, which means out of today plus 1 year, you're likely going to get something like 1,150 atoms delivered by the consensus. This is paid by inflation, okay? So remember, some of the token supply is partially diluted as well, so this compensates for this dilution. All right, now the validator fee is taken out of this, okay? It's never going to be taken out of that. The delegation never transmits the property of the tokens. Remember, the tokens are still in your own fucking custody. The validator only has the right, the validator set only has the right to slash these tokens if the validator you delegated to has done one of the slashing conditions we've mentioned earlier, okay? So that's really the way it is. You always are in custody of your tokens. It's not like you're sending your tokens to a smart contract, which is what happens in Ethereum staking, for example. In here, the tokens always are yours, all right? The delegators just are using it as collateral in participating in a consensus, and you get the rewards as long as your validator does it well, all right? So your validator takes a fee only on the rewards, because the rewards are actually sent to the validators and to you. Okay, that's the way it is. The distribution model, which does it in the Cosmos SDK, will separate the fee from the validator to you. Okay, so the 150 atoms generated and sent to you each and every block will be separated into a X% fee sent to the validator and the remaining onto your wallet. All right, so out of the 150, let's just go by the example of using a using a 0% 5 fee, okay? 5% fee, okay? So that would be a 7.5 atom kind of pay for the validator, all right? Now let's do the example with a 2%, okay? That would be 150 times 0.02. That would, okay. No, not 2%. Sorry, I just have done it with the French guy. But let's go for 2%, okay? Though, remember, 2% will be the bare minimum acceptable yield to be participating in the anti-chain security system. Otherwise, you're going to be pulled out because you're kind of downwarding competitively, trying to dampen the other users and the other validators. Okay, so let's go for 2%. That's really the rock bottom. You would be paying 3 atoms to the validator. Remember that the difference, though, is that over a year, okay, at the end of the year, you would then have 1,147. That's the reward you would get by choosing a 2% stake validator, a 2% fee validator, okay? On the other hand, remember what we stated. The other way around is going to be this, okay? So there is a 4.5 atom yearly difference between a 2% and a 5% validator. So for the delegator and the average delegator, which is far less than 1,000 delegation, do you see how insignificant that is? So now the question has to be, how the hell does the validator needs a fee? Well, I'm just going to give you rough numbers, okay? Today, it takes approximately $10,000 a year to run a Cosmos Hub validator on a server, all right? Just the server cost and the like. I expect this cost to nearly double, and that also means with the interchain security, there will be more and more chains to validate. So there will be more and more computation and storage required. So those costs are expected to nearly double. So that's $20,000 a year to validate the Cosmos Hub and its consumer chains. All right? Well, this money doesn't come out of nowhere. You're going to have to pay the validator. Remember, the validator is a technical operator, so it doesn't just is paying for the bare metal servers. You're also going to have to pay for the people running it. Because running one chain could be easy, but you still have to update the software. We've seen those validators, they generally validate multiple chains in the interchain. So they're going to have to keep up with all the updates of all these chains. They're now going to have to synchronize the stuff with the interchain security of the Cosmos Hub. So all of these things will have increasing complexity, which will increase the technicity required to operate a node correctly. This is how the intrinsic separations between the professional validators and less professional validators will occur. Interchain security is going to do one thing, and interchain growth is going to do just one thing as well. Forcing the validators to get more and more professionals, okay? It's going to require human input and a lot of work to keep track with all the updates, perform the updates correctly, avoid all the stupid double signing mistakes at all time, because if you do it just once, people are going to fly away from your validators across all chains, okay? So that's the way it is. That's a game in which you can't fake it. You can't miss it just one time. You're going to have to do it very well. That means, well, it's not just the bare metal servers cost in here. You're going to have to pay for technicians who are going to be able to run it correctly. So there are multiple costs for a validator. The bare minimum $20,000 a year provision for the validator kind of hardware stuff, but you're going to have to pay for devs to run it correctly, because a validator is going to try reducing cost by just doing it manually, a single man doing it at home. Well, boys, you can be guaranteed that it's not going to be able to scale to the interchain growth. So you're going to have validators who are true professionals, able to scale, they have good infrastructure. Though, if you think a fucking validator can sustainably run at a 0% rate, ask yourself the question, how the fuck does this validator run it profitably? They take no fee. They have a bare minimum $20,000 a year expense, without mentioning that the people who run it have to be paid. They don't do it for free. So how the heck do they make money? Well, the 0% validator, most of the time they're actually selling vote. They do vote bribings and all of these shady, nasty stuff. Though now you understand why the Cosmos ecosystem doesn't like the 0% validator. They're actually making some shadow stuff. They're actually getting money. They're just getting it off your backs. So when you delegate to a 0% fee validator, what you're actually doing is getting fucked, but you don't know it. You just think you're getting richer because they don't take 3 atoms off your ass, or a few atoms a year, though this is freakingly insignificant. Delegating to a 0% validator is full of dumb decision, all right? Don't make it, please. Moreover, over time, they will disappear just because of the mechanics of the forthcoming updates. All right? And then, like we stated, going from a 2% validator to a 5% validator is so negligible in terms of outcome. So what matters is, if you want to choose a validator who is long-term sustainable, go for the 5% ones. That's the average. So once again, you can try to go for the cheapest ones for just a few atoms difference by the end of the year. But the thing is that if you end up with a validator who is under strain because it doesn't have enough capital, it's going to run on cheaper servers, though it's going to get higher downtime, or it's just going to be technicals, operators who are just unpaid, so they're not going to work properly, they're going to miss updates, and they're going to just, in the end, look like poor technicals. And remember what it is, it's going to be a shuffling the deck constantly. It's a system that's made to incentivize the validators to be the best technical operators, because if you're not as good as the other, you're gonna be pulled down the validator set until you get out. Okay? That's really something that I hope you guys will be able to understand. Okay? The validator set is a constant competition. Choosing your validators, though, if it's not through the actual fee, if you state it could be governance, because you also delegate the right to vote on your behalf. All right? But the thing is that this is going to change as well. I'm going to say it because, well, this isn't too much communicated about, but we're actually going to release it. Though, first of all, I'm very proud to announce it. Some people have seen it already, but we do have a validator in the actual active set, and it hasn't been that easy to get there, so you would recognize the logo. Here we are. So I wish I could have taken pro validators, but as you see, there is a pro validator already, so I just couldn't be doing it. Where are they? Yeah, here. So we were just willing not to go by copying. Hopefully one day they'll get out and we'll be able to claim the pro validators kind of name. But until then, here we are. That's the best I could figure out. Pro delegators, you have the logo. This is really us, okay? So this is really, really us behind that thing, okay? Though the thing is, we do have a validator, okay? We're in this game of stake, which means, of course, we'd be happy to have your delegations. But the questions I really wanted to ask in here, like we stated, how do you pick and choose the validators? Though the number one choice is going to be not the fees, could be the governance, but I'm going to say it out loud. We're going to be a non-political validator. What does that mean? Well, that means we will always cast abstain votes. So what's the point? Well, if you delegate to my validator or our validator, because like I said, I'm not going to be the only one behind that. I'm certainly not good enough to run the tech. So there's going to be techs behind that. We're actually a group of 4 people. So there are 3 technicians in here. So like I said, I'm not in here for the short run and the quick bucks. I'm in here for the long run. And I know the technicity is going to increase parabolically. And I wanted guys who knew the shit they were doing. Okay. There were people validating on other chains for a long time now. They're not noobs. They just not came out of nowhere. All right? And they're not here for the money either, and I'll explain later about that. Though the thing is, if we are an apolitical validator, what the heck is going on? I mean, how could we do that? You know I have some ethics. You know I care about governance. So why the hell did we choose to be an apolitical validator? Well, this is something that I would like to explain. Now, give me a second. All right. Though the thing is that that's one of the things that we want. As it's going to be increasingly going technical, I think adding up to the governance burden on top of technical operation isn't going to be a sustainable stuff. Though you know me, I'm always years ahead of everyone, or at least my job is to be is to see stuff before they happen. That's what the trader does. So basically the thing is in here, I know that the governance is going to shift away from the validators that are going to do exactly what the interchain does and what the actual blockchain technology and decentralized ledgers are doing. It's forcing specialization. So I think over time, the validators will be forced to get technical operators at their best possible level by removing some of the other actual constraints. Like, I don't think governance is going to be linked to validators in the future. All right? Why do I say that? Because actually it turns out that we're going to be the ones breaking this bond. We've been working on that tool for some time now, and we're going to release it as soon as I can get the website up, okay? The first things we're going to be doing in here is, in the meantime, we incentivize you to cast your votes yourself as much as you possibly can, because we are all going to cast abstain votes, all right? If you don't vote, we will not vote for you. We don't think we deserve the right to choose for you, but we also don't think that if you don't vote, your votes should end up in an abstain way, all right? So what is the in-between stuff that we've built? We've built something that is basically going to allow you to choose whichever political delegate you will want to copy. AKA, today, if you don't vote yourself, then your validator has the vote. And if you don't stake, then no one gets the vote for you, which means your vote is lost in the ground. The thing is that, well, what we want to do is to allow anybody, delegators or non-delegators, to choose their political representatives. And this political representative doesn't have to be a validator, okay? This political representative can be any Cosmos address. As long as you know who belongs behind that address, because that person chose to be politically revealed, for example, take Jaquan or whichever Cosmos OG, as long as they say, well, this is my address. Doesn't have to be the address where they hold their atoms, okay, if they want to keep their financing private, but they can say, I will vote through this address, okay? This address is the address which I will be the one to vote by. Well, you can, with our tool, say, I want to copy this address, so that if I don't vote, My vote will be casted as this vote. And we, as a validator, will be casting these votes for you. All right? We'll be casting the votes, but not the votes that we do for you. We're going to be casting the votes that you've chosen to copy yourself. You can still vote. You can still vote yourself. But if you don't do it because you don't have time or you just don't care, well, you can elect any Cosmos address to be your representative. All right? That's how I think governance will evolve anyway. Today, it's not. Today, if you want to cast some votes on behalf of someone else, you're going to have to run a validator. Like I've said, I think it's not the end game. Validators have to be the best technical operators there is. They don't have to be the best politicians there is on top of it. Some validators, I bet, will make the choice of be very high standard of politics, and they will keep playing politics. Though I bet there will still be some high stakes political validators in the future in Cosmos and other Cosmos chains. But I think that this game is going to be severely diminished. Though we're also, and I like it, going to fuck the game of the 0% validators who are actually selling your votes because they won't be able to do it anymore. We're going to do anything we can to get as many token holders to use these vote delegation tools to slowly but steadily destroy this stupid class we're in which both technical operators have to handle the governance. All right? I think the governance is destined to be for those who want to be politically motivated in the Cosmos, those who participated in governance forum very actively. These are the ones who knows the shit they're talking about, and you will be able to choose whichever you think is good enough to represent you out there. All right? But the validators and the validator we have in here is not going to do it for you. All right? But we're still going to help you and incentivize you to participate in governance, either yourself by casting your own votes, and we're probably going to build a vote notification tool or stuff like that. There are ones existing like citadels and stuff like that. So the thing is, we do everything we can to invite you to cast your own votes. And if you know you can't because you don't have enough time or just don't care, we're going to give you the opportunity to give your token votes to whoever you feel is legitimate to be. All right? So that's one of the things. So that opens a second door. Well, if validators are going to be technical operators, if they're going to be chosen by default, like being good operators because the bad ones are going to be pulled out of the set, well, that leaves us with another choice to make. This choice is basically, well, now that we have that, okay, that we know that validators are likely going to be technical operators and less of both technical and political operators. There will still be some doing it. Well, we have to ask our questions. What are going to be the validators' differences? We stated that like the fee isn't really that relevant. On the previous video, I said then choose through governance. Well, I just said this is going to change, likely with the tools we're going to introduce. I see no other way around but to go this path. The validators are not going to be the actual political deciders. So how can you pick and choose the validators? It's, I think, important for you to understand this next stuff, all right? So if we pull the validators on the graph by on the y-axis, the number of delegators they have, and on the other axis, the total asset stake, the amount of stake collateral they bring to the table. You will clearly see that there are two types of validators on those two axes. You've got the ones that are really focused on capital. They have very little amounts of delegators. They do bring a shitload of money on the game. And this is where you figure out, oh, these are the ones that I know, right? These are all the capital validators. They're here, they barely vote, or they don't really pay too much attention to governance. All they care about is mostly just the money, okay? They want to get their share of the inflation. And from some of them, they're actually taking the most of that share for themselves and not redistributing them to their actual delegators who don't even know how this whole system works. And I hope you're going to help those people in Coinbase custody or every other assets, or every other centralized exchange to get their tokens out of there, please. All right? So that's one thing. Though you've got kind of the fun validators, those who care only about the economic model, they don't pay too much attention to either governance. They're probably going to be good technical operators, but most of them will charge a freakingly high fee. If you go back there, you will see how much they take, okay? They all take a far above average fee because, well, they have their own delegators. They don't really want you out there. They just have their own depositors, Okay, so that's really the way it is. Understand it that way. The capital delegators, they're not for you. Don't delegate to them. You actually serving a purpose out there. Okay. Then the second stage, you would see on the more closer to the vertical axis, well, who are there? Oh, Citadel, yeah, I think you know them. All nodes, this is a 0% validator, so fuck them, okay? Pro validators, low fee validator, stake lab, builders, okay? And we'll see a lot of them, 0% fee, informal, be harvest. These are core teams that have been built, core protocols and software for the SDK, okay? So you would see all of that, okay? Though mostly what you see in here is, aside from 0% fee or low fee validators, you will see service providers. Citadel's building a wallet, okay, and all of things like that. You've got Cosmos Station as well. It's kind of a hybrid, okay? They're building all of these things that we're actually looking at now, okay? So these are service providers. They build out softwares and tools for delegators to use or general interchain services. They're either building open source code or maintaining the technical Cosmos stack. These are people participating in the interchain one way or the other through services or code or database maintenance or whatever, okay? These are really actors that help the overall ecosystem. I would call them public good validators. They're building stuff for everyone, all right? Either they do it for the users on a more like Citadel-based system. They're building a wallet that everybody can use, but of course, they incentivize users to delegate to their nodes to kind of thank them as well. So that's the way it is. They're bringing services for everyone, and they're asking or pledging for your delegations in return. All right, you know that I particularly like Citadel. I'm an advisor for them for years now, and I intend to be in the long run. I got them liked and support their job day one. And the thing is that, well, you would ask yourselves, well, now that you have a validator, Phil, the fuck is going on? You're going to go into competition with Citadel? Well, we're certainly not going to be, because I intend to do exactly just like they do. We're going to be service providers on a different theme. I don't want to build a wallet and stuff like that. I don't want to compete with Citadel. I just want to bring some additional stuff to the table. Some of you who know me for a long time now know that I am more entrenched in the traditional financial system, all of the financial products and stuff like that. I do understand a lot about market mechanics and stuff like that, good financial manager and stuff like that. So I know a lot about these. I know how financial managers work. I know the tools they will be using, and these are the things that I think we will build. So we will be builders as well. Kind of just like Citadel. We're going to bring services to the table. We're going to build protocols, tools. We're going to give the access to those tools to everyone. Some of those tools will be associated with a fee, of course. And the thing is that the model we're probably going to be using is that, well, if you delegate a certain amount to us for a certain duration, kind of standing for delegation tiers, just basically, the more you delegate and for the longer for us, you're going to get to a higher tier, and these tier is going to give you the opportunity to probably use our services for free. Okay, so that's basically going to be it. Among the tools that we're going to build, I can name but a few. We're going to bring all of the possible insurances. Like if we ever go downtime, you're going to have a downtime insurance. We're going to pay back for the money you lost. And like remember we said, you're not going to lose money. It's just like you're losing gains, but we're going to compensate for the gains you lost if we ever go downtime by having downtime insurance. We're going to use a slashing insurance as well. Like if for whatever reason we ever are stupid enough to double sign, which I bet never going to happen ever, but if it ever happens, you're going to be insured and you're going to be given back that money, so that you can safely sleep at night knowing that never, ever, ever a dollar is going to come out of your wallet because of us. All right, okay? So all possible insurance, because that's what the traditional finance is all about, and I don't think I could ever provide a service without an insurance. So you're going to be insured for every potential problems that we could go with. Second stuff is that we say we're going to build tools, though I'm probably going to, not going to lie, saying we're going to build a dashboard with all of the financial management tools that I will be using myself, and I will offer those services for you. So like limit orders on different dexes, complex order, external triggerings, possibly, I guess, using your trading view alerts with the indicators to actually trigger some trades in the Cosmos and stuff like that. Having complex routing stuff. I mean, I'm going to look over the Cosmos, and anything significant to me, any services that I think are deemed to be included in our dashboard will be, okay? Of course, some of the services that we build ourselves will be associated with a fee, and this fee will be 0 for those who delegate certain amounts. That's basically the way it is, okay? There are so many services I intend to build, like critical analytics of your portfolios, constant risk-taking, rebalancing of portfolios, all of professional management tools. This is what I want to bring on the table, all right? So I hope you're going to like those tools, but I wanted you to understand what vision we have for pro delegators. We're not just going to be standing there and be good technical operators. We want to bring some tech to the table, offer it to everyone, okay? And of course, some of these tools will be associated with a fee, and you will be free of that fee if you delegate to us. That's the way we want to build a model, as a common incentive of creating public good technology that everyone can use, and you guys getting an advantage if you delegate with us. That's the way it is. On the other hand, also remember that though there will be builders validators, okay, core team validators, there will be just pure capital validators. There are also community validators. Remember that the thing is that Pro Indicators to me is a community. I've been working for free for years for these things. Like all of those videos that you have here. Have you ever seen a single advertisement on those videos? And ever, and it's never going to happen. I'm not getting paid a single cent from doing this. I'm working my ass off to get you the best possible content, to teach you how trading actually works, not the full of shit stuff all around the corner, like get rich quick schemes and dumping. I'm never going to do this, okay? Everything you have in the YouTube channel is for free. It's viewable for everyone. There's no VIP secret hidden stuff, whatever you're going to have to pay for. Everything is for free. I've always done it that way, and I always will do it. So if there's one thing I can tell to close that video is to say, well, I think there are community validators, like for example, CryptoCito as well, who doesn't necessarily have to provide tech and software and tools to be inheriting delegation. I think just like that, publicly committed to educate people by releasing educational video, educational content for free, I think this also has value. And I think overhand in the future, some validators will have these community implications by doing community job, unpaid job. And I think one way to thank these guys, like me, CETOs and the like, is to delegate to their nodes. And I think over time, some validators will have this direction as well. So that gives you the conclusion. Here are the types of validators there is. There are the centralized exchange and 0% fees and like that. Just get the hell out of them, all right? There are the fund validators like Polychain, Zero Knowledge Validators, Dokio Capital, Game, all like that. These are those who have very little delegators but very big babies behind them. These are just like hedge funds and like that. Okay, though you could still delegate to them, but they generally charge a much higher fee than the standard just because they don't want you. Okay, they offer private services for their private clients. On the other hand, you've got the public builders and the core teams, okay? So I think core teams, public builders will definitely be one crucial type of validator, okay? And on the other hand, all of the others who are playing the stupid political games of vote bribing, vote selling, and stuff like that, I think they're all going to have to change their business model. Either they're going to have to start to build and bring some things to the table, or they're going to disappear very quickly. On the other hand, like we stated, I think some other class of values will survive, like the CryptoCitos, hopefully mine as well, because we provide knowledge and visibility for this ecosystem. We work harassed to let people know about how Cosmos works. This is generally genuine work that is done for free, okay? This is charity job. And one way to thank for charity job, I guess, is to delegate to these nodes, all right? So, of course, I'm sorry, I had to do a little bit of self-publicity at the end of that video. I hope you don't mind me for this. Like I've always said, I'm not doing this for the money. And the final thing that I'm going to add up in here to settle the conclusion is, well, of course, Pro Delegator is going to be a transparent validator, because that's probably the last thing that I'm so going to complain about, the lack of transparency of validation today. Yes, some validators are definitely making a shitload of money, and no one knows actually how much it is. I think those validators have to release earnings details and stuff like that, like not necessarily on a quarterly basis, but at least yearly earnings and so. And we engage today that we're going to do this. I don't like to criticize bad behavior. I'd like to just show the good behaviors and set new standards. So we're going to be among the first ones to publicly publish revenue streams with details, use of proceeds, what do we make with the money, and stuff like that. But TLDR in here is that I don't want to make money. We are 4 people in here. We've decided to go 25% each ownership of the company. The company is going to be registered in Switzerland, and the thing is, basically, we don't want to just make money out of it. The money is going to be serving paying the devs, and whichever leftover there will be is going to either be used to buy and pay more devs, or just get you some money back through lowering the fees or whatever. But anyhow and anyway, I'm not here for the money. I've never been. I can't get to sustain my money flow myself. I'm not building that validator to get richer, okay? So that's really the way it is. I just want to change the behaviors in the validator set, and I'm going to use the influence I have and the quality devs that I managed to find out to just set new standards, to send a message to the validators. Those who play the 0% game, selling the votes, yeah, not going to make it in the future, okay? Those who build, well, good luck with that. We're going to build as well, and we're going to increase the pressure. You're going to have to build good stuff as well, okay? So instead of complaining on how badly the distribution of token is in the actual centralized validator set, or in the decentralized validator set, what I would like to set new standards, raise the bar, and let the people adjust. That's the vision I've always had. Stop complaining, start acting. So the reason why there is a validator isn't because I want to get rich. It's because I am disappointed with some of the behaviors in the Cosmos validator set, and instead of complaining and bargaining, I would like to change that. Set a higher bar, and I think the standard is going to just play this game itself. All right? That being said, I think you know everything, though I'm going to terminate with how do we actually do this. For those who don't know anything about delegating, I mean, if you're among the crowd who's actually delegating through a centralized exchange, you've never ever gone through self-custody before, well, like we stated, there are multiple ways to go. The safest way to go is to use a hardware wallet. So get yourself a ledger or whichever. I'm not advertising any particular branding here. The way it goes is pretty damn straightforward. You're going to have a wallet. The wallet that is included with your hardware wallet in here, for example, you're taking Ledger Live, well, you're going to easily be able to figure out for the big Cosmos chain, like the Cosmos Hub, right in from their front ends and stuff like that. You're going to be able to delegate your atoms, not the fucking centralized way, okay? This is self-custody, folks. They're going to be there. You're going to be casting the transactions. You still hold your tokens. You hold the private keys. You sign all the transactions and stuff like that, okay? That's the way to go. You can do it all in the Ledger Live application. You would be able to find whichever validators you want to delegate to. We're going to be into that list. You just select how much stake you want. Remember that you can stake to a single validator. Just avoid doing it to a single validator who's in the top 10, in the top 20, because, well, validator guys, Cosmos guys tend to like decentralization. So if you stake to a single validator, just don't do it in the top 20, okay? And then you can create your own mix of validators using the different profiles that we've mentioned. You can avoid, I think, delegating to fund validators. So now your choice is either you can support, I don't know, a YouTuber or influencer that you like and that has a validator to show some support for the work that it does, or you can target some service provider and builders to support their work, because most of the time you're going to be using their tools. So the best support you could do to keep improving these tools over time is to delegate to these validators. They're probably going to use the money they take out of a fee to build and maintain those tools over time. Remember that coding isn't for free. When you use a tool, someone has built it. The person who built it has to be paid some way. So the validators, I guess, in my personal sense of view, are not just there to take money off your backs. By delegating to certain types of validator, you're actually shaping the Cosmos. Today's way for you to shape Cosmos is to choose the validators which has the most political alignment with you. But like we stated, this game is likely going to change a year from now. So the next choices for your validators delegations is actually probably going to be the use cases they make with the money. Though like we stated, we're going to set some standards of transparency of use cases of the money that is sent to validators through the fees they take, so that every validator is going to have, in my humble opinion, to justify what they do with the money. Those who are just in here to make a few bucks, I don't think they're going to last very long. Those who truly build some valuable tech and services for the general public are going to be the ones to win the game in the end. I hope you understand that by now, because I did everything to explain it all. All right? If you're not going with a ledger device, well, of course, I sincerely recommend you using Kepler, delegating, true Kepler wallet extensions. There are multiple tutorials out there, so same old story. Just go easy on that one, okay? If you go with Kepler, once you've opened your Kepler account, it's really, really easy and straightforward. You go to the stake tab, you'll figure out all the validators in the list. That's pretty straightforward, okay? If you want to redelegate, like if for now you already have your tokens to a validator that you really want to change, like for example, if you're delegating to a 0% fee validator, I'm not saying, you can do your own choices, okay? But if for whatever reason you want to redelegate, let's imagine you like me and you want to thank me, which I would, of course, thank you for. You would go, for example, Pro Delegator in here, and you would start delegating your tokens. And if you already have some delegated token, you can redelegate from your existing validators. Okay? That's really the way it is. That's how it goes. It's very simple. Remember that what you do in here with the Kepler wallets, with all of things, is definitely self-custody. The risks associated with stacking, definitely close to zero, as long as you don't put a fucking centralized intermediary on top of it. All right, that's really the way it is. It's safe to stake. That is the safest thing to do in blockchain technologies. All right, try to validate the good tokens. Don't try to get into every Cosmos token. Try to figure out a bunch of tokens, because just buying Atom itself is very risky. You really want to go for the big games, big names in the ecosystem. Don't try to just over diversify, but don't just go all by Atom. That's really not the way to go. We're going to deploy some other validators on which I think are the key ecosystem players, like we intend to deploy in Osmosis, likely Evmos as well. We'll let you know, of course, through the regular social medias. Anyway, if you even choose to delegate after that video, thanks a lot, Guy. We're going to do everything to raise the bar, so thank you for your delegations. Thank you anyway for already bringing us that high in the validator set. This was really a weird experience to me to see the delegations going higher and higher day by day. So thanks a lot for this beautiful adventure we just got started. I hope we're going to be releasing the first tools and the dashboard I mentioned by the end of that year. It's taking quite some time to build these things, so I just don't want to give unfulfilled promises, but that's the direction we're heading, and now you know everything about it. Last but not least, before we go out there, remember that there is a 21-day unbunding, so if you bond your tokens, you're going to have to think that you're not going to get liquid tokens back until 21 days. So last point before we close up, if you want to maintain and retain the liquidity of your tokens, there are multiple options. The number one leading for now is using liquid staking. Liquid staking comes with its own sets of risks, and I'm going to go over the very quick review of them. There are multiple service providers. Today there are two of them. We're really leading the game. There's Stride, which provide you with a liquid representation of your tokens. For Atom, it's going to be ST Atom. Basically, you stake one Atom, and they're going to give you one ST Atom, which we're going to give you the opportunity of redemption of atoms on exchanges. Basically, you can sell your ST Atom to get an Atom back, okay? That's the way it is, and therefore you get an instant liquidity. The thing is that it introduces some intermediaries in the process, though it's not the same risks, okay? And you also understand that it's also different ways to do it. If you do it with Stride, Stride is going to delegate to every validator in the set proportional to their actual stake. So basically, Stride doesn't redistribute the cards. They just basically draw the cards the same way they are. They distribute the tokens you gave them to every existing validators, all right? Though you lose the ability to choose whichever validator you want to delegate to if you go liquid staking with Stride. Okay? Also understand that there could be slippage risks. If for whatever reason you want to sell your ST Atom to get some atoms when everyone else is trying to do it, there's going to be an asymmetry in the pools, and therefore you're going to recover less atoms than you deposited. So same old story, you can recover your atom at all times, but if you do it when everyone else is trying to do it as well, there's going to be imbalance, there's going to be some depay, all right? So it's of course some higher risks. Not to mention that, well, probably with Pro Delegators, one of the tools that I'm willing to buy is kind of an insurance during the undelegation period. So for whatever reason, if you unbound with an atom at $21 or so, and if for whatever reason 21 days later the atom has gone back to 18, well, we're going to offer tools for you to cover the difference in prices between the 21 days lockup period. Okay, so these are things that will come later down the line. All right? Though there is still an alternative which I would like to talk about. This is pretty damn an early chain, so pay attention in here, early code, early stages, and stuff like that. But you've got the alternative of Quicksilver, which is already offering Cosmos chain staking, liquid staking. And the way it is in here is that you will return governance, which I like, which means with this, you're going to be able to vote even with your Q atom. In here, it's not going to be ST atom, it's going to be Q for Quicksilver atom. This is the liquid staked representation of the atom you staked. But the thing is that they will give you the opportunity to choose whichever validator you want. Okay, so you set the atoms you want. Okay, you're going to be able to pick and choose the validators you want. We're going to be in that list. Okay, in here. So for example, you want to stake the pro delegators and some others. Okay, you're going to be able to choose. You stake or liquid stake through this protocol, and this protocol will still allow you to cast your own votes as well. So to me, that's the #1 choice to go, because this is where there are less trade-offs. You can choose whichever validator you want to send your collateralized value to. You can also vote on your own, though my personal favorite is by far Quicksilver, even though right now the common consensus is still to have much higher liquidity in Stride. So we'll see if the future turns the tides, but to me, best service is Quicksilver. By far. So anyway, now you know everything, though let me give you a few seconds recap in here, because there are plenty of things that have been said. So what happens is interchain security is the beginning of a long series of very profound changes in the way the Cosmos security is handled. It's very, very likely going to be a changing game for Atom as a position in the ecosystem. No more unconditioned airdrops and unguaranteed differential money flows. It's probably going to be lesser and lesser in the future. Moreover, there are probably going to still be some, but now Atom has a true spot, a true place in the spotlight, because security in Cosmos is a critically badly handled situation today. There are several different layers of security in Cosmos, and remember that if the vision of a multi-hop is really the way to go, which I definitely will go to, the thing is, this is always the lowest critical point of security that handles the security of the overall multi-hop stuff. So there is the need for a general standard of security in Cosmos, and I think that's the role Atom shared security system is here for. Mesh security could also be a solution in the longer term future to have that higher general standard of security across the Cosmos chains, so that the endgame applications can use any blockchain in the Cosmos with at least a base safety layer. Last but not least, that's another topic we will mention in the future, but IBC relaying is going to be a critical infrastructure to manage as well, and I think Atom is going to play a critical role in this game as well. So to me, I've never been as bullish on Atom as the latest few days, because I think we finally have a use case. Interchain security is definitely there, and the chains that are going to be deploying through this system are definitely high quality. So that's it for today, guys. Okay, now you know everything about the mutation of that security system. It's going to take some time to be put into place, so could be some short-term chaos, though that doesn't mean it's going to translate to immediate bullish price action on Atom, but I don't see how it can't be in the longer run. IBC is really winning the game, and there's going to have to be some standard of security. So now it's a matter of time to build these solutions, deploy, and actual value to be put into the Atom. All right? Until then, well, if you already hold some Atom, or if you intend to get some, now you know everything there is to know if you intend to go for the safest way to get some rewards with your Atoms. It's not to go degen yield farming and stuff like that. It's the stake. And if you stake and participate in a consensus, the best possible way to do it is to first of all understand it and know how to do it well. I hope I've answered all those questions today. That being said, it's a 1.5 hour long video. I'm sorry guys, but I think that was necessary. Don't forget to share that to anybody you know who is intending to buy Atom, especially if they're intending to do it from centralized exchanges. And moreover, if you know somebody who's already having Atom but staking it in centralized exchange, please do them a favor, get them out of here. Bye guys.